You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we have Greggs, Entain, Ibstock, Darktrace, Dominos, and our US company of the week is Nike. But first, Sam, do you want to say a few words about the Investor Way meetup that we had at Terry Smith's AGM for Fundsmith?
Yes, so this was a while ago. It was actually, so just for reference, it's the 23rd of March today. It was on the 28th of February, I think, that we went. So we went down to London and we didn't talk about it on the show because we didn't think anyone would be interested, but we did actually get one listener that asked us why we didn't review it afterwards, for which we profusely apologise. However, we went down and it was very nice to go down and meet some of the listeners. So we actually had a group of about 10 or 11, which was probably about 10 or 11 more than we expected. And it was a very good group as well, I must say. But we had a very nice day out in London. We went to see Terry Smith and Terry was fantastic. I did think it was I did definitely really like it, seeing him actually in the flesh. It's kind of like going to a concert, isn't it? I know it's a bit sad to say that, but there is something different about seeing it live. But Terry was fantastic. Presentation was as you would expect. I don't know what I'd have to say about the actual, Terry's, discussions themselves. It was quite interesting. One thing that was very interesting was he sort of looked at how, they'd gone back and tried to recreate the data of how his portfolio stocks would have done in the 70s in the last high inflation environment, and showing that thesis that the high quality companies do win out. I thought probably the highlight for me was there was one point where someone asked him, I can't remember the exact scenario, but someone basically got asked something basically along the lines of are there any problems in the portfolio? And he just made this throwaway comment where it was well, there's always a couple of problems in the portfolio. The issue is that we don't know which couple. But he was very, very good, very, very succinct. You knew he'd sort of rehearsed it. He knew it very well. Very, very good experience. I think I can't recommend it enough, actually. I would recommend going and finding it online and just watching it. It's on YouTube. It should be on YouTube for free. It's only about an hour long. And just, by the way, when you get there, one of the questions read out was by Paul Adal, and we had the honour of sitting with him in the audience as his question was read out to Terry Smith. And then he signed our books at the end, which was very nice. Do you have any comments, John?
No, I thought it was fantastic. Very interesting to hear his analysis on a couple of companies. It was very well rehearsed, but still very interesting nonetheless. And Ian King from Sky News, the business editor, did a great job of sharing the questions from the audience and back to Terry. But no, all in all, it was a fantastic experience. Does make you want to invest in the fund, or at least you buy into that quality compounding strategy, I suppose.
Well, I have actually since kept my 100 shares. I might keep them for the sentimental value.
Yeah.
Not the 100 shares, the £100 of shares, to be clear.
No, that's right. I'm not sure what fraction it was. It was about £15 worth of shares, but the trading fee was about the same. So I don't think I can actually sell it now. But anyway, it's going to sit there. It's going to be my ticket to future years.
Yeah, although we didn't actually need the ticket. The security was pretty lax. I think it was just an email registration. I don't think they get that many gate crashes typically. But anyway, should we talk about some company results?
Yes, and there is a Terry Smith favourite. I think Dominos, one of his top performers, which is later in the show. But Greggs, first of all. So Greggs reported their full year results with full year revenue up 23% to £1.5 billion, whilst like-for-like sales in the company managed shops rose by 17.8%. Revenue growth was driven by 147 net new shop openings, an increase in prices, and a strong first quarter that benefited from a lockdown-impacted comparable period a year earlier with Omicron. Profit before tax was up 1.9% to £148.3 million. And higher revenue was largely offset by significantly higher costs and reduced support from the government pandemic measures that had been in place over the prior year. Free cash flow of £152.4 million was down from £235.3 million in the prior year, the difference largely due to increased investment. At the year end, net debt, including lease liabilities, was £109.7 million, compared with £84.6 million in full year 21. 2023 started with like-for-like sales up 18.8% in line with expectation. Cost inflation is expected to trend around 9 to 10% for the full year. Board has proposed a final dividend of 44 pence a share, giving the total year of 59 pence, compared with 57 pence in 2021. And the shares were broadly flat in the day's trading. In terms of valuation, Greggs has a market cap of around £2.7 billion and trades at 22 times forward earnings, which is broadly in line with the 10-year average. I thought these results were very good, although they were somewhat flattered by the impact of Omicron and more favourable comparables, but it is on the back of a long-term growth trend, and the group is planning to increase the number of franchises from 17 to 20%, which will allow it to scale without all of those additional expenses. I think there is still significant room for growth in the UK, particularly in the south of England, although you may argue that the north of England and possibly Scotland are somewhat saturated. I mean, I know back home there are at least 2 Greggs on every high street. That's certainly not the case where I'm living at the moment. It seems to be coping relatively well so far with the inflationary pressures and has maintained a cash position of over £190 million. But I think if there were to be a more significant downturn and prolonged sort of cost of living crisis, then that discretionary sort of lunch spend, you could see those numbers under pressure and falling. And it's certainly not cheap at 22 times forward earnings. So I do like it as a company, but I probably wouldn't be brave enough to pay up for it. I think that would be where I'm at with Greggs at the moment. What are your thoughts on these numbers and Greggs as a business, Sam?
I think these results are very good. Although, like you say, they are against easy comparatives. I think we had that in the couple of years we've been looking at Greggs. This was a real lockdown loser. A lot of their stores are in high streets and places like that where they need that foot flow in order to do well. Obviously, things have actually returned to normal a lot more than we thought they would have done a couple of years ago. But it's hard because I guess you're almost looking at it from the point of view of like someone who's in the south where you're looking around and not really seeing Greggs. But as someone who's in the north, I think their targets are aggressive. I think 2,300 shops to 3,000. I don't know. I think it's too aggressive. And I don't like the high street dependence because I think that could possibly be in like quite long-term decline. These are good results, but I think it's quite expensive. And I think there's probably like other businesses that I prefer. So these results are actually better, although it has benefited from easy comparatives. But for example, like Dominos, which we're covering later in the show, the UK listed Dominos. I really like that business and have for a long time. And I think their targets are much more reasonable.
We will come on to Dominos. But
yeah,
without sort of any spoilers, you'd say that Dominos is much more saturated than Greggs is, though. So the growth there, and particularly,
I think Greggs is pretty saturated anyway. I really do. And then
you're pretty close to Greggs HQ, and I suppose you do see that it is saturated. I mean, you see it's probably 3 on the high street where you are.
Yeah, but they're talking about like a 50% rise in the store count. It's like there's expanding, and then there's like who's looking around and thinking, I wish there were 50% more Greggs about.
Me,
and I know in like sort of like in Newcastle, Leeds, Darlington, those areas, it's like there is literally a Greggs on every street. I wouldn't invest in it. I do love it. I love the business. I enjoy it as a customer, but I absolutely would not invest in it. You said the same thing though, didn't you? Opportunity cost.
It's opportunity cost, and it's a lot to pay up for. However,
they've got to hit those aggressive targets to justify the price you're paying. So if you're in any way skeptical about it, you just can't. I don't think you get to the point where you're going to buy it.
Yeah. On to another company that we've covered quite a lot recently, Entain.
Yes, so this might actually be quite familiar. I think we might have covered the trading statement, and now these are the full year results. So a lot of it we've probably already been over, but this is a business that I think we find quite interesting. So we're going to go over it again. So Entain, by the way, are the owner of various betting companies, including bwin, Coral, Foxy Bingo, and Ladbrokes. And they've also got quite a lot in Europe. Like they've got one in Croatia. They've got quite a few. They're a global gambling company, I guess. And they also have joint venture BetMGM, which is trying to crack the US, which is probably the most exciting part of the business. So they've come out with their full year results, and full year gaming revenue rose 10% to 4.3 billion, excluding the effect of exchange rates and excluding the joint venture in the US. That reflected a 66% rise in retail and a 2% decline in online as comparative periods lapsed COVID lockdowns. BetMGM reported net gaming revenue of $1.44 billion, an increase of 71%, and is on track to be cash positive in the second half of 2023, including Entain's 50% stake, and Entain's overall net gaming revenue rose 15%. The number of active online customers rose to record levels, up 7% on last year. At the group level, reported underlying cash profits rose 13% to 993 million, reflecting the increase in revenues. Underlying net debt increased from 2.09 billion to 2.75 billion, thanks to continued spend on acquisitions. Free cash flow fell from 456 to 428 million. A dividend of 8.5p a share has been announced, bringing the total to 17p for the year. It's worth noting that Entain estimates the North American sports betting and iGaming markets will be worth approximately $37 billion, and they have continued to gain market share and the number of states in which they operate. So you'd hope they'd get a pretty good chunk of that over the long term. Debt did increase in the past year, as previously mentioned, and that's mainly down to activities, including the BetCity acquisition. And currently, underlying net debt is 2.75 billion, which is 2.8 times cash profits. That's at the level I'm probably fairly comfortable with. I think it's about 4 I start to get nervous. And as well, I'd probably give it a bit more leeway just because it does have that BetMGM, which is growing very, very fast. In terms of valuation, business trades at a forward PE of 18.9, and that compares to a 10-year average of 13.1. However, 10 years ago, it didn't have the US joint venture. So you're not comparing similar. Well, I know it's the same business, but it is very different now to how it was 10 years ago. And the prospective dividend yield is 1.4%. My view is these are very good results. And I think the US venture continues to do very well. There's not really much in there from when we covered the trading statement last time, but I do like to keep an eye on this. So as with the trading statement, these are very, very good results. I wouldn't invest for ethical reasons. I know you're the same, John. Ethical reasons aside, what do you think of the valuation and the business?
Putting those aside, I think these are very good numbers. And for the prospects of the US sports betting market and where they're placed, I mean, it looks like there's huge growth ahead of it. And I know they haven't turned cash positive yet on BetMGM, but that is coming. And when it does, gosh, it's got, I think there's a lot of potential in this business for sure.
Right, moving swiftly on. Another one we've covered quite a few times, although we do have a debut afterwards. Ibstock.
Yes, it's probably a less exciting business to most people. We've covered it a few times. Very steady. It's a brick maker, and it's the largest listed brick maker in the UK. They had their full year results out with full year revenues growing 26% to £513 million, largely driven by higher sales in the clay division, which rose by £89 million to £369 million. This helped underlying cash profits, EBITDA, grow by 36% to £140 million. Net debt rose from £38.9 million to £45.9 million, and underlying free cash flow fell 1.4% to £49.7 million, as higher operating cash flows were more than offset by increased equipment spending of £33.4 million. The group also spent £30 million on a share buyback. Activity in the early weeks of 2023 has continued to reflect the more cautious demand environment seen in Q4 2022, and it's anticipated that conditions will remain subdued through the early part of 2023, but are expected to improve as the year progresses. A final dividend of 5.5 pence per share has been recommended, growing the full-year dividend by 17% to 8.8 pence per share. And shares were down about 1% on the results. In terms of valuation, Ibstock has a market cap of 11.6 times forward earnings, which is just below its 10-year average, and it currently yields 4.5%. I think these results on the surface were good. However, as we've covered with the house builders previously, the property market is cooling as the cycle begins to turn. And we are seeing it hitting Ibstock, or beginning to hit Ibstock, and that's not going to be getting any easier. There's also the background of high energy costs, which, if you're making bricks, does significantly impact you, although bricks are something that people generally don't want to import for obvious reasons. And it's certainly not an expensive stock at the current valuations, but given where we are in the cycle, I wouldn't see it as that cheap. There is a lot sort of structurally going for it, quite literally, no sort of pun, but it's, I think, a little bit too expensive for where we are. The fundamentals, though, with the UK having far fewer homes than it needs, and the demand, all political parties committing to more house building, is underlying, support or fundamental support for Ibstock. But I don't think I would be buying shares. Sam, what are your thoughts on Ibstock, these results, and where we are in the cycle?
Excellent results. Really, really good. I don't know. I hadn't really thought about Ibstock for a while, but like the very good year that the housing market's had, that's followed through. That's flown through, and not just housing as well. I think just any kind of building. Like it's anecdotal, but if you speak to anyone trying to get a builder for anything at the minute, it's very, very difficult because they are just fully booked up. Not so much now as 6 months ago, but even still, outstanding results. That return on capital employed is fantastic as well. So it's 23.4%, which I would not have expected it to be that high. I guess the only problem is that it costs quite a lot of money to increase that capital base. But yeah, really, really good results. I agree, based on what we've seen with the house builders and what their comments on the early weeks, that probably not going to be as good next year. I agree with your comments about where we are in the cycle, but I think Ibstock will be a little more insulated in that it's not completely dependent, although that is a big part of its revenue, it's not completely dependent on the house building market. And, if the house builders are going to continue building houses, they do have to pay for the bricks, whether they like it or not. So, yeah, that being said, I think with the year, if it has 2 or 3 bad years on the back of a poor housing market, I think you'll probably be able to get it cheaper than 7 times earnings. Or if you do still get it at 7 times earnings, the earnings will be a lot lower than they currently are. But in the long term, I do like it.
Not enough to buy shares right now?
No, I did used to own shares, but I think I sold them a couple of years ago for opportunity cost. But it's a good dividend payer, and it is a good business, and I think it is a good play on the housing market. I wouldn't be against owning them in the future, but the main issue is, yes, they've had a very, very good year with like revenue rising 26%, but it's just not the kind of business that's going to grow revenue 26% every year. And there's a very good chance revenue falls this year. So I just thought in the long term, where's the growth actually going to come from? And I'm not really at a position where I'm buying shares for their income. So that was why I got rid of it. But in 30 years, I might buy it back.
Okay. On to a more growth-orientated company, Darktrace.
Absolutely. Darktrace. So this isn't a company we've covered before. However, it has been mentioned in at least 2 of the interviews that we've done. So I'll go to the company overview, and take it with a pinch of salt because this is from the Darktrace website, but I'm just going to read their basically company page. Founded by mathematicians and cyber defense experts in 2013, Darktrace is a global leader in cybersecurity AI, delivering complete AI-powered solutions in its mission to free the world of cyber disruption. We protect more than 8,100 customers from the world's most complex threats, including ransomware, cloud, and SaaS attacks. Our roots lie deep in innovation. The Darktrace AI Centre, based in Cambridge, UK, has conducted research, establishing new thresholds in cybersecurity with technology innovations backed by over 125 patents and pending applications. The company's European R&D Centre is located at The Hague, Netherlands. With groundbreaking self-learning AI, Darktrace empowers bespoke solutions unique to each customer based on continuous visibility into an organization's entire digital ecosystem. Darktrace is now executing on a cyber AI loop, an industry-first set of cyber capabilities that will not just prevent, detect, respond, and heal from cyber attacks, but do it all at once. An always-on feedback system with deep interconnected understanding of the enterprise creates a virtuous cycle in which each capability strengthens and hardens the entire security ecosystem. Our customers include public sector agencies, education institutions, media, organizations supplying critical infrastructure, and businesses of all sizes across every industry. Headquartered in Cambridge, UK, Darktrace has more than 2,000 employees located across more than 100 countries. Darktrace was named one of Time magazine's most influential companies for 2021. They have come out with their half-year results, and revenue is up 35.8% to 259 million. The gross margin is 89.7%. Net profit was down 86% to 581,000. EBITDA was up 9.1% to 36 million. Adjusted EBITDA was up 32.8% to 59 million. And net cash inflow from operating activities was down 52% to 27 million. They have said they had continued strong year-over-year revenue growth across all geographic markets and customer sizes amid a challenging macroeconomic environment, including a comparatively unfavorable foreign exchange environment. 99.3% of revenue was from recurring subscription-based contracts that continue to average approximately 36 months. Operating profit decreased 6.3 million between periods to 0.6 million, primarily due to elevated share-based payment and associated employer tax charges relating to vesting of grants made at IPO. These are expected to normalise in the second half of this year. At 27.1 million, all these figures are in dollars, actually. That's unusual. Anyway, at 27.1 million, net cash inflow from operating activities represented a decrease of 30 million from the prior period due to the expected 20.7 million increase in employer taxes. And there are a few interesting points in the slides. So they have a constant currency annualized recurring revenue growth rate of 36.6% and a 24.4% year-over-year growth in their customer base. They've said they've got over 130 patent applications. In their AI research center, they've got over 80 master's degrees and over 30 doctorates. In terms of their percentage of revenue, 17% comes from financial services, 13% manufacturing, 11% energy and utilities, 7% legal and HR, and 6% government. 47.5% of their customers have 4 or more products. That's very good because that's going to make those customers very, very sticky. Because if any of those customers want to leave, it's going to be an absolute nightmare for them moving everything across. And they've also said the average size of existing customer contracts was up 12.4% year over year for contracts of 1 year or more. In terms of the customers with annualized recurring revenue over 100K, that's up from 900 a year ago to 1,342 this year. So that's growing quite a lot. It's about 50% actually. The 1 year gross customer churn rate is 6.5%, so that's pretty low. And their net ARR retention rate is 105.1%, so that means the customers are spending 5% more every year. So revenue growth is 35.8%, very high gross margins, no profits, but it's probably just not at that stage yet. Market cap's 1.95 billion, doesn't pay a dividend, doesn't have a PE ratio, or not one that you can actually use, which makes it very hard to value. It does, the closest thing I'd find, price to gross profit, 8.4, not too bad. Although, really, you're getting pretty close to price to revenue and to price to sales when the gross profit margin is 89%. You'd hope with a business like this, once they've got some scale, a lot of that gross profit would start feeding through into operating profit, and this could be a very, very high margin business. It is in that kind of industry. In terms of the share price, it's currently trading at a share price of £2.76 a share, and that compares to a 52-week low of £1.98 and a 52-week high of £5.59. And if you go back further, on IPO, it came out, I think, at about £3 a share, so current share price-ish. Went all the way up, so it looks like it nearly got to £10 a share. And then it's since down 75%. These are very good results. It looks like a very good company. It looks like a lot of the, a lot of the SaaS companies we used to cover in like the COVID bubble, for like a lot of the American stocks in terms of the results it's putting up. They are absolutely fantastic. I think it's very hard to value though. And my main concern is I know it tells you all how many doctorates it's got and everything else, but it's kind of like a pharmaceutical company. I just, it's difficult.
I was thinking exactly the same. Yeah.
How do you know if what they've got is good enough? Firstly, to prevent cyber attacks for the customers, but also to prevent someone else coming out with something newer and slicker, because they're saying that their AI learns and stuff. So I think Quality Compound James, he could make quite a good argument when he came on for his interviews. But I don't understand the product. I've never used the product. I think for me to buy it and to be comfortable with what I was holding, it would have to be very, very cheap. And it doesn't look like it's very, very cheap. It might be in terms of, if it can carry on growing at 35% a year, and then it can have margins of 30 or 40% one day. But you need to understand a lot of things that I just don't understand. So it looks like an interesting business. I'd be keen to cover it again. Maybe I'll start understanding it, although I think that might be slightly ambitious, but not for me. John, your thoughts on the results in the company?
Yeah, I mean, they look like very good results, and it's a business that's growing rapidly. It is that, like you say, a business that's very difficult to understand, and it feels like you need sort of a doctorate to be able to understand it. Yeah, I think that would stop me from going any further. Obviously keen to cover it going forward, though, and it's a growth industry, and it's not, one of those few, I suppose, tech companies that we have in the UK, which is exciting. But yeah,
it is. It is unusual covering this and it not being the American company.
Yeah, exactly. But that's where I struggle. So
maybe that's why that negative attitude. Whereas they've got a can-do attitude in the States, they'll just buy it anyway. I suspect if you dug in as well, it would be a lot cheaper than its US peers. I can't imagine many of its US peers with those kind of growth rates are trading at. I mean, that was 8 times growth. What was it? 8 times gross profits with a 90% margin. So call it like 7 times sales. I mean, some of them were going at like 50 times sales in the height of the pandemic.
But I mean, it's across the board, even in industries that aren't growth industries, the valuations in the States are higher, and you are having more British companies talking about relisting in the States.
Yeah. But no, interesting company. I'll be keen to cover it again, but it's not one I'll be buying anytime soon.
Yeah. Okay, well...
Should we move on to a much simpler business?
I was just about to say that. So Dominos, the UK arm of the business, had their full year results out with group revenue up 7% to £600.3 million and 18% ahead of pre-pandemic levels. Underlying EBITDA, however, fell by 4.6% to £130.1 million, with the group citing accounting treatment of investment in cloud-based technology platforms, a lower contribution from the German associate business, and an additional £2.4 million in accelerated amortization and impairment related to the technology platforms, in addition to an increase in interest payments of £4.9 million. In terms of operational highlights, 90% of the group's sales are now digital, with app orders at 52.2%, and app customers rising by 16% to 6.1 million. And collections also rose by 22.3 million orders, which is up 33%. The group also benefited from the World Cup, and market share in Q4 grew by 8%, with like-for-like growth of 13.9%. Statutory profit after tax rose 4.2% to £81.6 million, following an exit from the loss-making international operations in full year 2021. And the group proposed a final dividend of 6.8 pence a share, raising the total yearly dividend by 2% compared with full year 21. This is alongside the £86 million of share buybacks already announced, and that totals £366 million returned to shareholders since March 2021 through dividends and share buybacks. Net debt stood at £253.3 million, which equates to roughly 2 times EBITDA within the company's range. And in the first 10 weeks of the new year, trading has been up 10.8%, and orders at the end of Q4 stood at 18.5 million, which is a record high. Below par store openings, though, sent the shares down by 9%. In terms of valuation, Domino's trades at just under 15 times earnings and has a market cap of 1.15 billion with a yield of over 3.5%. I thought these results generally good, and you are seeing the group making positive steps, exiting those loss-making European operations, and they're closer than ever to a German exit. However, it does raise the question of where the growth is going to come from going forward and how saturated the UK market is. And I think for me, that would be the main concern about where Domino's, if we are at peak Domino's in the UK, where we go from here. And I think that would be the reason that I wouldn't buy shares. And it's unfortunate that those operations that they've tried in Europe haven't been successful. But yeah, it boils down to where does the growth come from? And I think I probably wouldn't go any further. I think it was probably quite a different situation, or well, it almost certainly was an entirely different situation when you had Terry Smith looking at it 10 years ago, and we were nowhere near peak Domino's, but I feel that we probably are there now. So yeah, not one for me, Sam.
I disagree with you. I really like it. I have to be careful because it is just a business that I really like. I think it's a fantastic business, but I'd argue it's not really priced for growth. You're paying a 14 PE, and what's that 14 PE? That's on pretty poor results. So it might be more like 11 to 12. You're getting a dividend yield of 3.65%. The targets are actually modest and pretty achievable, unlike Greg's. They're talking about going from, like, say, 1,200 stores in UK and Ireland to 1,400. And they're getting rid of all these loss-making overseas subsidiaries that have been impacting on the results for the last however many years. You look at the amount of cash they're returning to shareholders, where is it? 130 million of shareholder returns announced in 2022, including 86 million of share buybacks. That's on a market cap of 1.15 billion. I appreciate they can't sustain it at quite that level every year because they won't have a subsidiary to sell every single year. However, they do have one selling the next year, so you might get a similar thing. So what is it? What's the one they're currently selling? Is it the German one?
German.
Yeah, so they're selling the German one, so they're getting another 90 million cash for that as well. I think that they've got over a 40% share of the UK pizza market. It's a fantastic business. I really like it. I think at 14 times earnings, it's one of my favourite businesses that I don't own. I think I really, really like it at that valuation. I think if it was at 20, I mean, we've covered this in the past, and it used to be at, over 20 times earnings. And now it's at 14, and that's 14 on reduced earnings. So I'd say yes, it's not going to hit that kind of growth, but it's not priced to. So I might take a look at it. Actually, I do. I don't think I'm quite there yet, but it's definitely good enough for the watch list, but clearly not for yours.
Okay, interesting. Nike.
So Nike, another watch list stock, although this one's pretty pricey.
Yeah, unfortunately.
Yeah, it's not come down since we last looked at it. No spoilers though. So Nike have come out with Q3 results. So Nike Direct Sales, which is a direct consumer offering, probably the most exciting thing about the business at the minute. And all these figures are in dollars. They were 5.3 billion, up 17% on a reported basis and 22% on a currency neutral basis. Nike brand digital sales increased 20% on a reported basis or 24% on a currency neutral basis. Wholesale revenues grew 12% on a reported basis and 18% on a currency neutral basis. Revenues for Nike increased 14% overall to 12.4 billion compared to the prior year, and were up 19% on a currency neutral basis. Revenues for the Nike brand were 11.8 billion, up 14%. And up 19% on currency neutral, with double-digit growth in North America, Europe, Middle East and Africa, and Asia Pacific and Latin America. Greater China grew 1% on a currency neutral basis, despite a challenging December following the shift in the country's COVID-19 policies. On a reported basis, revenues for Greater China declined 8%. Revenues for Converse were 612 million, up 8% on a reported basis and 12% on currency neutral, led by double-digit growth across all channels in North America, partially offset by declines in Asia. Gross margin decreased by 330 basis points to 43.3%, primarily due to higher markdowns to liquidate inventory, continued unfavorable changes in net foreign currency exchange rates, higher product input costs, and elevated freight and logistics costs, partially offset by strategic pricing actions. Selling and admin expenses increased 15% to 4 billion. The demand creation expense, which is a fancy term for marketing, was up 900 million, up 8%, primarily due to advertising and marketing. Operating overhead expense increased 17% to 3 billion, primarily due to wage-related expenses and Nike direct variable costs. Net income was 1.2 billion, down 11% compared to the prior year, and diluted earnings per share was 79 cents, down 9%. Inventories were 8.9 billion, up 16% compared to the prior year, primarily driven by higher product input costs and elevated freight costs. Cash equivalents and short-term investments were 10.8 billion, down 2.7 billion from last year, as cash from operations was offset by share repurchases, dividends and capital expenditure. It highlighted that they have had 21 consecutive years of increasing dividend payouts. In the third quarter, they returned approximately 2 billion to shareholders. However, that is on a market cap of, I'll just get the figure, 187 billion. So it's unlike Dominos, which is returning almost 10% a year. Nike's more like 1%. So that was made up of 500 million of dividends, which was up 9%, and share repurchase of 1.5 billion. Over the past 10 years, what do you think the average? I'm going to quiz you, John. So I'm going to put you on the spot. Last 10 years,
no.
what do you think? What do you think the average revenue growth was for Nike? And that's per year.
Between 10 and 15%.
Oh no, 7%.
Okay.
But do you want to guess what the average earnings and cash flow percent increases were per year?
5%.
So revenue was up 7% a year. Cash flow is up 39% a year, and earnings up
Bloody hell.
22.86% a year. So I think they are just getting better at selling you this stuff for a higher price. And dividends were up 11% a year, and the dividend's still tiny. So it just shows how well the shares have done. I think it's interesting though, because I don't know if I told you, but like when I went to Bucharest last month, we went to like a shopping mall at one point, and I was looking for some new trainers. So I like went in the Nike and Adidas stores, and they were actually more expensive than they are in the UK.
Really?
I was like, well, I'll go over there and get them for like half the price. And they were actually, it was like £200 for what would have been £100 pair of trainers. I think that's partly because it was the capital, but I couldn't believe how expensive it was. Yeah, and like, you look around, everyone's walking around in like Nike and Adidas. And I bought 2 pairs of Adidas trainers like a week or two ago online. Like in terms of the directing, it's fantastic. It's like you can just filter by your size, so you don't have to waste time looking at like shoes they don't have in stock. And it's so much better than like going to a shop and doing it, and it's cheaper. I think it's a real problem for like businesses like, well, for example, JD. I really do. I don't know why you'd go in and buy your shoes in JD now, because like you just get the right size delivered to your door. Like they will charge you less for doing it, like free delivery. I just don't know why you'd go and do it in a store, you know, because you're going to spend however long looking at shoes as well. Like just little things like you can filter by price. So you don't even have to waste time looking at shoes and then looking at the price and just being horrified. Anyway, I've gone on a tangent. In terms of the valuation, the business trades at a PE of 33, but a forward PE of just 30. And the Nike PE is 56% higher than the S&P 500 average.
Gosh.
John, thoughts on the results and the valuation?
I mean, it's extremely expensive, but they are good results. Very high quality business. It's just, very hard, I think, paying up for such a high quality company. I guess that's ultimately what it boils down to. Same category as Coca-Cola. It'd be, I'd love to own the shares.
I would love to own this at half the price. Probably might even be less actually, because even at half the price it'd be a P of 17, and I would probably think that's quite a lot. But you know, if the share price came down 60%, I'd definitely have a look.
Yeah,
I wonder what it did in COVID. So the COVID low, is it March 2020? Is that right? Yeah, it looks like it was a low of like 60. So it actually did get, I think it did get cut in half in COVID, and then it's gone back up. But I could have well looked at it. The problem is, like, if the earnings come down as well, you look at it and you say, well, it's still 20 times earnings. But Yeah, it's doubled in like the last 5 years. There it is actually. Yeah, the return in the last 3 years it's returned 89%, and in 5 years it's returned 83%. It's about a 4-bagger in the last 10 years. So it's pretty good. That the problem is the valuation's so high now.
Yeah,
and it's so big as well. But fantastic company and fantastic brand. So, of the 6 companies we've covered this week, Greggs, Entain, Ibstock, Darktrace, Dominos UK, and Nike. If you had to buy one, which one would it be?
I would probably go for Greggs. A little bit pricey, but I think the growth is there. Fancy portfolio only, though. I don't think I would be with my own money.
If ethical concerns weren't an issue, would you still pick Greggs?
I think if ethical concerns weren't an issue, there does look like there's great potential for Entain in the US.
I think I would go.
If I were to say, where do I think the shares would be in 5 years' time of those UK companies? I mean, Darktrace is a bit of an unknown, but I would probably back Entain to be at the top.
Yeah. Okay, I'd go with Dominos UK. I think I would probably go with it over Entain, actually. I wouldn't back. I don't know if I'd back. This sounds ridiculous, but I don't. I don't know if I'd back it to beat Entain over the next 5 years. But there is more to that, more than that when you think about an investment. In terms of, I think the downside risk of Dominos is much lower. Whereas with Entain, if the US side doesn't work, that is a pricey stock. I think there's based on the results they're putting up, I think there's a very good chance it could work. So I might not mind taking that risk. But I don't expect Domino's to be the best performer, but I think it'll do well enough that I'd be quite happy to own it. I do really like the product as well, which helps.
Yeah, and you've got the regulatory risk there with Entain as well, which you don't, bar some major change in policy, you don't really have with Domino's.
No,
you had to start to have lots of fast food taxes, but
well,
I'm sure they just not passed on anyway. So.
Yeah, and it's not actually that ridiculous a suggestion, though, is it? It's definitely something that over here, less of an issue for Daddy Domino's in the US.
Exactly. Yeah.
But anyway, right,
Nanny Domino's here. Sorry, that was terrible.
I like that. Right, I don't know how.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.